Okay. Bang. There we go. So just as a quick aside, as Mark said, Stephen's going to be back next Tuesday, and I was working on the deck on Saturday, and my daughter calls from college and said, "Hey, what are you doing?" I said, "Well, I'm putting together a presentation. I got to fill in for the GOAT on Tuesday."
The GOAT.
And her response to me was, "Well, Dad, just don't be the WOAT." I said, "The WOAT?" She goes, "Yeah, the worst of all time." I said, "Oh,
Oh, I've never heard of that. That's good.
So we'll set the bar nice and low for myself." So I thought I'd talk a little bit this morning about the market environment that we're kind of going through here to start the year. And I'll start with interest rates. Obviously, it's been a concern, and we came into the year. This is a chart of the 10-year. We were at 163 basis points, and by early March, we had got to, on March 8th, 174, and the S&P was down about 12.5%. Now, during that time, obviously, Russia invaded Ukraine, so that had something to do with it as well. And was interesting, the market actually from early March to the end of March was up almost 11%. And during that time, rates continued to rise. But then we had this last sort of bump in rates during April, hitting 290 bips on the 10-year. And we saw the market then, correct back down about 8%. So, the market's really trying to digest where interest rates are going. And it's important, obviously, because it's what we use to discount future cash flows or future earnings. And while we all know this, I thought it was interesting. You put it down on paper and actually see the numbers, and it reminds you as to why they're important, right? So I just took here, I said, if I've got an earning stream of $10 million, it's growing 10% annually. I don't know if you can see it on the screen, but it's going to grow. I can't see it because I'm blocked here. Bear with me one second.
We can see it.
So you can see how it's growing, right? Now, if the discount rate that we're using is low, as it's been, let's just say 25 basis points for argument's sake, you can see that there's, a minimal impact to the discounting of those future flows, right? Now, take that and we move it up to 2.5%, still a relatively low interest rate. You can see that the discount, because of that rate, shaves about $4 million off on those flows. So, this is sort of the battle that's sort of going on in the market, and you've seen it really hit growth stocks, because here, again, you're paying for that future growth. And just I put on here the S&P is down. At the time I put this together, was down 10.5%, but you could see the tech ETF down almost 18, the software component of tech down 23, and the semiconductor component of tech down 24%. And this is reflective of, again, these are businesses that are typically growing at a much faster rate and had been priced as such in a zero interest rate environment to reflect that. And as we're adjusting to higher rates, you can see obviously these are the areas they got hit pretty hard. So this is the adjustment the market's making to rates. But I thought I'd take a step back and take a look at sort of the secular outlook for technology in general. And last week, Bloomberg released a survey that they did of over 3,000 chief technology officers across different industries. And what's interesting, 61% of those surveyed expect to increase their tech spend this year. And of those, 72% of that 61% expect to increase it 9% or more. So a pretty healthy environment for technology spend. And when you dig into the survey, not surprisingly, their focus is on cybersecurity, marketing technology, and AI. as well as cloud computing as well. So all the areas that we've been talking about, sort of the buzzwords in the industry, and against this backdrop, still a very healthy CapEx going into technology companies. And then also on the secular outlook, last week we got a report out of McKinsey on the semiconductor industry. And they're predicting that the semiconductor industry, which is about $600 billion today, is going to grow to over $1 trillion by 2030. And here again, we've been hearing so much about the automotive industry and the challenges to manufacturing because of the shortage of chips. Not surprisingly, it's going to be a big driver of semiconductor revenues going forward. And just to give you some sense, when you look at a level 4 autonomous vehicle with an electric drivetrain, the semiconductor content in that vehicle will be about $4,000. And you compare that to today, sort of that level 1 assisted driver car, it's running about a $500 semiconductor content. So a big boost coming from there. I think semis, autos represent roughly 8% of the semiconductor demand today. By the end of the decade, it's going to be upwards of 15%. So it's almost doubling. And the other areas, again, kind of make sense. Wireless demand will continue to stay strong. You've got, strong demand backed by the rollout of 5G. And then, we've talked about in the past at ARS, the data super cycle still being in the early innings. So you're going to continue to get pretty strong demand through cloud computing and AI, robotics and the rest. So the compute segment and the data storage segment for semiconductors continues to have a really strong tailwind. And sort of the bottom line of the McKinsey report is you got still a very bright future for the semiconductor industry as you look out, even given all the sort of the near term volatility and challenges, the future certainly looks bright there. So with that, let me just come to, the valuations. And the question I ask is, is this the pause that refreshes, or do we continue to see pressure on these names? And I just picked some of the sort of the bellwethers in the industry. One being NVIDIA, which is sort of right in the the forefront of all of this. I mean, they are critical to the compute power, whether it's AI or graphics. And you can see the stock's down 34% year to date. We've seen the PE multiple, which was running at about 55 times earnings at the end of the year. And what I did is I said, let me look out to future earnings power in the years out. If at 22% growth of earnings per share, we get to $12.50, at these levels, that's about a 15 multiple, right? So right now we've gone from 55 to 35 on next year's. If you look out at current prices, a 15 times multiple for a business that's going to be critical to the industry, that starts to look really interesting. ASML basically has a monopoly on the EUV lithography equipment that's critical for the semiconductor production, right? They are basically have a monopoly. If you're building a semiconductor fab, you need ASML's machines. You have to go to them. So they're sitting again in a great position for an industry that's growing. Stock's down about 24% this year. We've seen the multiples come in from 47 at year end to about 34 times 22 earnings currently. And again, another business that is growing well above trend, 17%. It's going to get us to about $33.50 in earnings in the out years, and at current prices, that's 18 times earnings. So again, as we look out further, these things starting to look pretty interesting. And then the last one, Microsoft, obviously critical into the cloud and the enterprise software side of things, down a little bit better, down 19% year to date. Multiples come in to just under 30 now. And again, a business that's growing double digits gets us out to a little over $13 in earnings. And that puts us at a 21 multiple. So again, as we're looking at these things, the question is, when do you step in? And right now, given the uncertainty around interest rates and sort of the Fed path, we expect we're going to continue to see some volatility here in near term. So it might be tough to step in now, but I would just say that we're probably close to forming a bottom, and we're trying to look past sort of this near term vol, and it's starting to set up for these businesses once sort of we get a little bit more clarity on where rates are going to settle, that these things you'll start to see capital flow back in because of that earnings power that they have, and an industry dynamic where that secular growth is firmly intact, but it's getting beat up a little bit right now. So, Mark, that's what I had. Open it up certainly to questions and comments.
Sean, that's not good enough. We need more. No. I figure this is going to prompt some questions here. So what are your questions? What are the questions and thoughts?
Hey, Sean, those forward PEs, that is really interesting stuff, because everybody keeps complaining about how the PEs are in the stratosphere. But those, as you mentioned, are a lot more reasonable. Do you see that kind of across the board in kind of tech, or
Bill, I think
is it more localized in certain groups?
Well, I think any business that didn't have the earnings support, right? Higher rates have had a much larger effect on the contraction of valuations, because you didn't have, when rates are that low, your present value of those future cash flows is roughly about the same, right? So if you're missing a little bit on that future earnings stream, it's not going to have that big of an impact. But as we start to set those discount rates higher, it's going to magnify that miss, right? So any business now we kind of associate higher growth with technology, but I would argue that it's really any business that doesn't have the earnings support here. The rise in rates has punished the valuations quite a bit. I mean, you can look at biotech. It's struggled now for a while, and it's really, to me, it's coming back to the uncertainty around where rates are going to settle. And to that point, Bill, where do rates settle? We're under the view that we're probably somewhere around peak rates right here. Could they get up over 3? Yeah, on a 10-year. I guess they could, but think about that in historical perspective. The average 10-year yield in the 70s was 7.5%. In the 80s, it was 10.6, 90s, 6.7, 2000s, 4.5, last decade, 2.4, and we've been running about 1.5 now. So let's say we end up sort of 2.5, 3. From a historical perspective, it's still a fairly low discount rate. And I think that's what's confusing the market right now, I think, is where are we going? There's a lot of, you've seen Bullard, to me, he's the guy they say, hey, you're the hawk, go out there. And this is the Fed Governor Bullard, who first came out at 50 basis points. You remember, I think it was probably back in December. Then when everybody got on 50, now he's out at 75. But then you take someone like Bostic, and that's per meeting, right? So he's calling for 75 at the May meeting. Then you got Atlanta Fed Governor Bostic, who was out last week or the week before, and he said, hey, listen, we've got to also pay attention to growth. So Bullard's talking the inflation theme. Bostic's coming out and saying, hey, we also have to take into account growth. And, while we think right now the economy can handle higher rates, I think it was under 2% was his target for year end. If you look at what the market's pricing in right now, I think it's just under 270. Right. So we're at an effective rate of 33 basis points right now on Fed funds. To go to 270 by year end that's what's got the market spooked. But long answer to your point was, without the earnings support, higher rates have really taken the hammer to valuations for those businesses.
Right. Yeah, it's interesting. Kind of another question is in this case, are high prices the cure for high prices? And you go going historically, you go back to like 1937 is an interesting data point, because in that year, inflation was moving up, not as dramatically as we have it now, but essentially consumers got priced out of goods that they really needed to have. And so we saw demand destruction come in, and interest rates inflation went from 5% to -2% like in 6 months.
Yeah.
And the S&P was rolling over a little bit beforehand, but it dropped like 53%. Now I think the overall circumstances are kind of different, and the mechanics that can happen today are different from then. But I think to seeing what's going on with the PE expansion coming back in is somewhat analogous to our high prices a cure for high prices, and buyers start going on strike. So we might be able to muddle through this without horrible consequences and the Fed having to really step on it. Because the other thing is that the curve is so darn steep at the super front end that it's like, is it doing the job for the Fed anyway?
Right.
Sean, I have a question. So you've covered very nicely one element of the valuation, which is the discount rate. The other question is, has the market consistently, in tech in particular, overestimated the total addressable markets of how much these technologies could grow? Meaning, so we know you're telling us how to discount the cash flows, but are the cash flows going to be as high as the market thought? Has there been a noticeable adjustment to what people believe are addressable markets for a lot of these companies? Now, the three that you put on the slide, they're monopolies or quasi-monopolies. So they have a tremendous amount of ability to capture markets. But what about the broader market and growth there?
Yeah, Greg, I think you do have to look at it on a company by company. But let me just talk about, when we think of the demand drivers, right? And I'll use a company as an example, but it's more broad than that. Like, we talked to Micron. I want to go back probably to, I think it was 2017, 2016, right? And they were talking about, their business, and, it was a very cyclical business when basically memory chips were used for PCs. I mean, that basically was the demand market for them, right? And then you look at a phone, you look at a smartphone, the amount of memory that your first phone had relative to where we are today, huge increase. You look at cloud. The CEO made a comment that, you go back 5 years, we had no cloud business. Now this is, going back, 16, 17, 5 years prior, they didn't have a cloud business. And the cloud business now is growing at 30-40% a year, and it will continue. We think we're still early mid innings of cloud adoption. So another driver that they didn't have, auto. He's come out this year and said auto is going to be their biggest driver going forward that wasn't there. We just talked about autonomous driving going, content going $4,000 from 500. So my point being, and then we look at, listen, we've always created data. Now it's actually being used. So when you look at AI and machine learning and all of these things are new that require, and I'm just talking about memory now, but memory chips, and you talk about NVIDIA and the processing. All of these things are new demand drivers that previously weren't there. So every business is cyclical, right? But the peaks and troughs should be flattening out going forward. And typically what that will mean is it warrants a better multiple because you have a better visibility. So we're of the view, ARS is of the view that these are secular drivers that are, somewhat early mid stages that will support that addressable market that you're talking about, that the demand is there coming from so many different areas that previously weren't there. And you've also had some consolidation in the industry when you think of memory. Basically you're down to 3 players with Micron, Samsung, and Hynix. So there's a little better discipline in the production, right? So the supply demand becomes a little bit better managed when you have fewer players. So there's some other dynamics as well. But yeah, we do think that the demand drivers are real and are robust as we look out. And you could argue McKinsey's saying the same thing with their report saying we're going to a $1 trillion business sector, if you will, by the end of the decade.
Great points. Thank you very much.
Greg, since you reminded me, we're thinking about emerging markets, interest rates, the impact on them. Maybe you could speak to that, but also, have you been tracking what seems like let's say, manipulation of rates and currencies as it relates to the ruble? Or is that something you're not tracking?
Well, I mean, listen, the dollar has been strong. We think it's going to remain strong relative. If you look at where we are, and we're embarking in a rate hike cycle. You've got Europe that's got a concern there that ultimately there's a high probability now they're going to roll into a recession. You got China easing. So imagine the dollar stays relatively strong here, which for emerging economies is difficult, right? Particularly their dollar debt. So it's we don't see that pattern changing anytime soon, Mark. The dollar should remain pretty healthy here.
Okay, maybe Greg, to teach
Yeah, so last week were the IMF World Bank meetings, and that topic was top of mind. Emerging markets, dollar strength. Are we in the presence of a resetting global financial architecture because there's been a weaponization of the dollar via sanctions? On the ruble specifically, what's been interesting is, after the sell-off prompted by the war and the initial application of sanctions, the reports we're getting is the ruble is stronger. A speaker from the IIF, the Institute of International Finance, that track capital flows, basically made a great point. And it was, even with the current sanctions, Russia had a current account surplus last year of $120 billion. They're on track, if things go the same way they are up to now, to go to $240 billion current account surplus. So that's showing the porousness of the sanctions and what happens if you don't completely embargo the oil and gas trade. Now that particular person, and only that person in all the meetings that I attended, basically said that he was expecting Germany to announce a total embargo of oil purchases from Russia this week. I didn't find anybody else in the meetings who shared that opinion. And in fact, Janet Yellen a few days later said, let's be very careful to do that because the impact on Germany, Europe, and the rest of the West is going to be dramatic. if we move to a cold turkey. So that puts, that explains, I think, a little bit of the ruble. In terms of other currencies, I mean, what's been going on is incredible, right? I mean, yen depreciation, RMB, the yuan, 657 CNH today. It was 635 a couple of weeks ago. It's a pretty sharp move. The impression of China loosening may just be that. They're again targeting very specific macro prudential areas where they're loosening policy, but the PBOC balance sheet is not growing. So there's not an across the board tightening, a loosening in China. And as a matter of fact, I mean, there's a lot of confusion in the markets on where these things are going. So a lot of turbulence, very negative views in the IMF, World Bank, in terms of just there's not a lot of optimism on where the world is heading. And the 2 points that I'd like to raise, I had heightened these in October when the last ones. The pushback against this very quick move towards ESG and carbon replacement is growing, because there is a realization that it's expensive, it's lengthy, and some of these targets, while being great, are very, very hard to reach. And the other one is there continues to be pushback against China as a global citizen. I'll stop there with that.
You just
Gregory,
said-
sorry, go ahead.
No, Adam, I was just saying you rang out like 6 subjects all deserving of an hour discussion.
Yeah.
Go ahead. Adam.
Gregory, a little more, I'd be interested more in what you heard about the ruble. Those reserves are inaccessible to the central bank. I mean, much of this is in foreign accounts. And because of the sanctions, the Russian government and those VTB, Sberbank, and what have you, don't have the mechanisms to settle a lot of the payments. So how does that?
Well, so
The ruble is artificially maintained at this rate. Yeah, I mean, you don't.
All right,
I'll leave it there.
no, I agree with that, but it goes back to the effectiveness of the sanctions, the porousness of the sanctions, and the phased implementation of the sanctions. There's some that have been announced that are still not fully implemented.
Sorry.
Yes.
Right. Yeah.
I think that's, and I want to bring in Michael Spett, because we were talking at lunch 3 weeks ago, Michael, about how important the gas is to the chemicals industry in Germany. Again, we can all, hindsight's 2020, whether even Merkel supported, Nord Stream 1. But what's
here in Germany, we have a huge discussion about what we can do and what we will do. Today, it was announced that the German government will deliver tanks to Russia. Yeah, that's the first time that they did that. Yeah, and this will not be bypassing the existing rules. They will deliver this directly. Yeah, so that's the first step. But the gas problem in Germany is evident. Yeah, so we have a strong chemical industry which which are consuming 20% of the gas in Germany. And if you switch it up, the chemical industry for itself, it will collapse. We cannot do that. Yeah. So our current foreign minister, which is from the Green Party, and they are looking for alternative resources. He is now looking for some resources in the Middle East. Yeah, and he's negotiating with normally the guys. They will never do that if they can deliver some gas, fluid gas to Germany, but we need ports for that. Yeah, so even if we will do that, there is no way that we can escape in the next 18 to 24 months from any kind of gas import from Russia. So the dependency can be dropped down. Also by getting some deliveries from Yes, but never we can stop any kind of transport or using more than less than 70% of gas from Russia. This is a problem because we have to pay this, and this is also an impact to ruble, because Putin announced that he like to get paid in ruble and not any longer in euros. And this is it's causing the problem that we are working on some parts a little bit contradictory what is necessary to push Putin a little bit back. It's for a certain time the German economy cannot sustain without gas. So at the moment we have 50% on renewable energies. That's all, and not more than that.
And you gave up and you walked away from nuclear. What is it? I heard that you would take a 6% hit to your GDP, but it seems to me that it's more than that because it ripples.
Oh,
But
it's not 6. It will drop down to 3.
I mean, I'm talking about your economy. GDP would go down by 6%. But
It's more than this will. The drop down will more than that.
I would think so. Yeah.
Michael,
Other-
the gas is not being paid for with rubles. My understanding is Putin backed away from that. Is that right?
Nobody knows exactly.
My understanding that they just refused to say, they just said, forget that, we're gonna keep paying in euro.
Yeah, that's right. Yeah.
Yeah.
Either
Yes.
way,
Yes.
They
No-
loosened,
nobody knows what happened behind the scenes. That's the official.
Well, that's
way to
true.
do that.
Yeah, that's true.
but let
on
me,
the headline side, that they did back off of wanting to be paid 100% in rubles.
That's right.
The other thing is, for example, Gazprom, I read an article that Gazprom Bank is currently acting as a de facto Russian central bank. So they keep moving that function to unsanctioned entities. And as a matter of fact, you still have a functioning payment system around the oil and gas industry because the sanctions have not all been applied.
You're
Well,
saying that the
Gazprom also
Gazprom bank has
an
not been
amount of-
sanctioned? Come on, really?
Excuse me, Lauren?
I said the Gazprom bank has not been sanctioned?
As far as I know, they're still clearing,
Can you
yes.
believe it? Can you believe it?
so
They excluded 3 major banks out of this, which are not being part of the sanction of the SWIFT system, and Gazprom, and 2 other banks which are doing the oil and gas transactions are not affected by that. This is a fact. Otherwise, there is no way to handle or to make any transaction happen.
and then since Chris White is on the call and knows the energy markets, we had that talk last week, Chris, about the U.S. being, we have the supply, but it's the storage, it's the infrastructure. But I heard yesterday, I guess it was a couple of days ago, there are initiatives to increase that, and that we could make a decent impact. I'm using that's a very precise word, decent. It was a podcast I was listening, so I can't remember. But can you just speak to that part of it? Like if we're in a Marshall Plan of energy to Europe, what can and cannot be done in the short and medium term? Chris.
Well, on the gas, Mark, no hiccups, critical path, no problems on permitting or equipment or construction. 3 years from pull the trigger to an LNG liquefaction plant, on the US Gulf Coast. So if it's not already in the pipeline and into that somehow by a few years, you're just not going to see it. Now, there are, I think, 8 or 10 projects that are in the pipeline right now that are scheduled to come on between now and, let's say, 2026. I don't have that in front of me, and I don't remember exactly how much that is. But you know, for a Marshall Plan for Europe, you're going to have to take a 10-year view here if you want to do this with US gas. Now, there's a lot of other gas in the world, and I would suggest to you that some of that gas could be brought to Europe faster,
We talked about.
perhaps. An example here is all of this deep water oil, this pre-salt stuff in Brazil is has gas associated with the oil. And that gas is now being either consumed in the operation of FPSOs and so forth, or most of it's being vented. And I would suggest to you that that's an opportunity where you could do something here with some floating LNG facilities.
Mhm.
Instead of bringing this gas onto land, which would require building a lot of infrastructure in the water, and probably isn't going to happen for more than a decade, that there's an opportunity to do something there. There's certainly some opportunities in Nigeria, for example, where there's an awful lot of gas being also burned or vented.
Chris, the other issue here too is on the other side, the regasification facilities, right? So if
Sure.
we're delivering LNG, Europe doesn't have the facilities to even take it, right? So
That's
to Mark's
a little
point, the
easier.
timing isn't, the timing on this, Mark, is years, not months, right?
Yeah. It's a little easier to build the regas facilities.
Yeah.
They're not as capital intensive and they're not as complicated, right?
Yep.
Basically, entropy works. So that's right. There right now is not really the capacity to take it, even if we had the capacity to deliver it. So if you want to cook something up here that can get Europe off of the Russian gas in a hurry here, you know, there's gas in the Black Sea, offshore Romania, that should be developed on a fast track. I think it probably will be developed. To say that anything in Romania happens on a fast track is
I mean, would
very
anything
difficult.
offshore in the Black Sea be like safe and secure though?
Sorry?
Would anything, any kind of development or like a project like offshore in the Black Sea be safe? Because I mean, Russia, you know, the Russian Navy pretty much, you know, controls the Black Sea.
Not anymore.
Okay.
Well, you know, there's no such thing as safe. If you want to invoke the possibility of Russian military intervention, building an LNG regas facility in England isn't safe, for that matter. Well, everything's reachable with missiles. So I don't know. I think the answer here is a little bit of everything. Got to go in all directions. So, and the other thing is here, you got a lot of countries in Europe that have taken a very hard stand against fracking. And the possibility of producing more gas from the Western European countries is non-trivial as well. But you know, it's going to require long laterals and these big fracks. And for instance, that isn't going to go down well in France. But for sure, you could make some gas in the Paris Basin.
Any other
So
comments, guys?
Yeah, just a quick comment here. So Chris, I mean, these are all good topics to discussion, but everything that I think's been discussed in this forum so far just seems like it just takes time to get through a lot of these challenges. And
for sure.
I think the one thing that kind of sticks out in my mind is just the astronomical inflation that's going on, and the thousands and millions of products that are byproducts out of the oil industry with plastics, with countries replacing medical supplies that are all hinged on plastics that are going to be affected by this disruption, is just going to astronomically have price increases.
Well, yeah, indeed, you've already had them, right? So, but, I guess a couple of observations here. It would be my opinion, and I know this is a minority opinion, but I'll offer a piece of data here in a moment. It would be my opinion that the backlash against oil and gas production and consumption peaked already and is now subsiding. And in support of this, I would offer the following. Last June, about 1,500 asset managers managing about $40 trillion had signed pledges to divest entirely of oil and gas and coal producers. And $40 trillion is a lot of money. I'm told that the total investment assets in the world are about $250 trillion. Okay, so that's a big chunk of money in the world. And now, that was last June, and today, or last month, actually, this number was $40.3 trillion. So after rising very rapidly for 2.5 years, this hardly rose at all in the last 9 months. And I think that's telling you something here. So, Europe's going to have to decide here what they're going to do and how they're going to do it. And it's not going to be pretty. I suppose I'm pretty sure that the answer has to include a considerable nuclear component as well for power generation, right?
Chris, I think it was about a month ago, maybe 6 weeks ago, we had a conversation about the Italians had gotten into a contract with the Algerians for gas. And these are existing pipelines under the sea, from what I understand. Are those, could those pipelines be connected to the rest of the pipeline network on the continent?
Well, they are connected to the pipeline network on the continent.
But it's just not
the
enough.
problem is all the gas in Algeria is now spoken for. There ain't no more gas. Okay, so, so you got another little increment here, and that's all there is right now.
Got it. Okay. Thank you.
You could do, there's a couple of little things around the edges. Tunisia has never put any gas into the pipeline to Italy, although the pipeline crosses Tunisia. And they have some sort of a weak contract right to do so that they negotiated when the pipeline route was laid out and so forth. That's obviously a negotiation. That's not been something that Algeria has ever been interested in, because giving your competitors space in the pipeline is not necessarily in your interest. So, but there is some gas in Tunisia that could be gathered and put into that pipeline in pretty short order without a lot of capital, if that were to be negotiated. But it's not that much.
Chris, is there any significant amount of gas or petroleum that is transported via shipping? Reason I ask is whether or not this newly proposed Istanbul channel, or, you know, that they're talking about a new route into the Black Sea, if that is going to have any impact or any, on this dynamic.
I don't think so, because basically the Northern African gas is piped. And everything else, it's a lot closer to come into Western Europe, to a regas facility in Western Europe. So I don't see that as mattering, but yeah, sure. All of this LNG stuff, Lauren, is ultimately transported on LNG tankers.
That's right. So we're coming close to the end of 12. We talked earlier about having an energy transition deep dive. And so I think we definitely do that. Sean, before we break, do you want to just explain to people what Nitin's going to talk about at 12 in case people want to go visit, check that out?
Yeah, really addressing the uncertainties in the market, and how we're looking at interest rates, the war, inflation, some of the things where there's what I'll say a wide dispersion of potential outcomes, and then some things that we're looking at that we think the outcomes are much more predictable, and how we're managing between the two, if you will. I think the title of the call is Looking Through the Fog. So that's sort of the basis of the conversation today.
So I put in the chat the link. I think it's the registration link that you gave us. So if anyone has
Yeah, I did as well earlier. So love to have you guys on if you have the time. Probably about a half hour in prepared comments, and then depending on how long the Q&A goes, we'll probably cut it off in an hour, but that's sort of the time frame.
And then again, next time we have our briefing, we're in Chicago. So if you guys have any questions, let us know. But tomorrow at 10:30, there will be a meetup to talk about, to go through the Chicago run of show. Friday as well. Reach out to any of us if you have questions, or if you have anybody. I see Michael's decided to come join us, Michael Savant. And anyone else will just reach out to us. You know how we roll. We will have
And if you're coming in early, let us know, because there'll be a few folks that will be coming in the day before, and there's a lot of fun stuff to do.
There are White Sox games. There are orchestra,
classical music concerts. There's going to be a lot of fun stuff.
and yes, it will be hybrid, Natalie. Including the breakouts. We will have different rooms. There'll be one device, and everyone will introduce themselves and have a chance to. You won't be able to. It's tougher for the sidebar conversations are tougher. That's why in person works, but we'll still make it. We'll try our best. Any last questions, comments?
Are the Cubs in town that week?
Lauren's not a Cubs fan, but
Actually, that's kind of broken down a little bit in Chicago. Literally, it's not as intense as it used to be. So it's okay to be a Cubs fan on the South Side now.
Peace.
Make sure you have your Bears or Bulls hat handy in case somebody challenges you about your.
Will you be handing those out in the South Side tour? Okay. Yeah, I'm really excited. I got a lot of people are converging.
Me too. As I said, you have no idea. It's really even encouraging that the people are going to be coming from all over, everywhere, to come here to our city. I can't wait to show you guys around. Really.
Perfect. Again, there'll be buses from the Residence Inn heading down to South Side and then back up. Everything will be right around there for the rest of the time. And then people, hopefully from the south side that we'll be seeing will be coming up and interconnecting in these breakouts over ping pong and all the rest. So Mariana's back on camera. I know you're excited. So
Flying in from London, you hear me? To come to Chicago.
so I want to break.
That's something, right?
I wanted to break, but Pascal, you just texted me, but or if I was just looking for the European perspective on this energy transition, but if you have a quick comment, welcome that. It's all.
Oh, sure. Let me just put the down because otherwise I look like a shining light. It's a disaster, basically. So you have left-wing politicians really pushing for a very, very quick transition, but which is in practice not even possible. So it's a nightmare in my view, to be honest, because it will take time. It won't be. I mean, Rome wasn't built in one day. And people, especially on the left side of the spectrum, seem to forget that. And in the meantime, they are also favoring a very aggressive stance towards Russia, in my view, more and more. So it's a tricky balance that we face here.
Well, I appreciate that. And I know that begs other questions and comments and discussion, but we're now officially done. So,
Even better. Great.
so thank you, everybody. Appreciate your time.